Chris, it's Mark Diamond again. I have a question on that very point. I guess it was last week, maybe the week before, the Treasury Department and HUD released a joint report on reforming America's housing finance market, and it essentially proposed several options of what to do with Freddie Mac and Fannie Mae. They were just options, though. Is there a clear-cut path or a clear thought on the Hill as to what to do with these two organizations? Because the President's proposal doesn't seem to have any definitive action in it.
Yeah. So there's two questions on this. One is, what do you do with Fannie Mae and Freddie Mac? The second is, what do you do for the future of U.S. housing finance? How does the U.S. housing finance market structured going forward? So one, I think the Republicans in the House and the administration are in agreement that Fannie Mae and Freddie Mac need to be wound down. They need to be abolished. They need to end. And we just need to start them on that transition now. The second question is, what role does the government have in the future of U.S. housing finance market? And there is where they lay out kind of three different options on what the future role of the U.S. government is in our U.S. housing finance markets. Congressman Garrett has been outspoken that he wants, for a longer term, U.S. housing finance markets to be free of government support and government guarantee, except for a very narrow slice through FHA and VA. That's where he is. And that's where he's going to be advocating and pushing for. He's been very outspoken on that. And then the administration lays out two other options. One's a government reinsurance option, and another a catastrophic reinsurance option, and another one is to kind of essentially have the same program that we currently have with just new Fannie and Freddie's going forward. So those are the three criteria, three areas. I can tell you where Chairman Garrett is, but we're going to keep working. We're going to hold hearings. We're going to investigate. We're going to dig in deep on all these other options and try to come to a consensus going forward.
Chris, we do have a audience question if you're ready.
Sure.
The question is, with typical losses on a foreclosed mortgage approaching 50 cents on the dollar of debt, does Congress understand how big of a check they may have to write?
So I don't think that Congress does understand how big of a check they possibly have to write. A lot of it's going to depend, as I said earlier, on the health of the housing markets going forward, and what state the economy's in, because that's going to be a driving factor. There are tons of foreclosures that are bottled up. You all hear the stories that banks don't want to take the losses to their balance sheet, so they're not foreclosing on some of these properties. They're letting the people live in there, stay in their homes for free for a year or two, while the person's next door neighbor is working very hard and sweating to make their monthly mortgage payments. So you've got all these backlogs and foreclosures, and you've got to get these foreclosures through the process, because you've got to find a bottom in the housing market before it can start going back up again. And the losses that are already baked in, they're already baked in. That's why it's important to transition away from the current system that we currently have and get a new system in place going forward that's going to allow for a much healthier and a much robust housing market than we've seen in the past, in the past number of years.
Chris, it's Mark Diamond again. I have another question for you, if it's okay.
Yep.
It's one of the joys of being the moderator is I get to ask as many questions as I want, and I don't have to type them.
Happy to do that.
There is some commentary going around that without the federal government backing securities for mortgages, that the 30-year mortgage is a thing of the past. Do you think that the private market can fully absorb 30-year mortgages? And is that something that's going to be available for future homeowners?
Yeah, so this is the common criticism I hear from a lot of people who support a government role in our housing markets, is that there won't be ever a 30-year fix. Congressman Garrett and it disagrees with that assumption. And there's a number of reasons why. The 30-year fixed product has been around over the last 80 years, and to suggest that now, even if you don't have a government guarantee to consumers, that the demand will not exist for that product going forward. I tend to think, a lot of if there is a very huge demand for a product, then that product will be offered. Will it be at a higher rate without a government guarantee? Perhaps. How much of a higher rate? I don't know. Will it require a larger down payment? Yes, perhaps. Is that a bad thing if you're requiring more down payment? I don't know. That was one of the problems that got us into the housing problems that we're in, was not a down payment. And are there other ways? We look at other countries. Other countries have very robust home ownership rates, and they do things. They finance differently. And so the 30-year fix is an important product. It's one that helps a lot of consumers get into houses. We don't think it will disappear if you remove the government backstop. We think there's ways that you can either through appropriate subordination of securities, or through a streamlining or harmonization, if you will, of underwriting standards, that you can produce that homogeneous product that so many investors look to in terms of their investment decisions, to keep the liquidity needed for a 30-year fix there, to keep it at an affordable rate. Will the basis points go up 50 basis points? Could be. Will they go up 100 basis points? Maybe. So I don't think we disagree that it'll be a little more costly, but that could also wind up making house prices cheaper, which could actually wound up being a wash for a consumer. There's been one gentleman, Dean Baker, who's done a study out there that says payments without a government guarantee, based on an analysis that Mark Zandi did, that monthly payments for a consumer would actually drop by about $100 based on a typical average loan size if the government guarantee is not there as opposed to it being there, because the government guarantee drives up the price of housing, even though the financing is cheaper. And so if you have a cheaper house but maybe more expensive financing, that could easily be a net wash. And so we're looking at all these factors. We're going to have hearings specifically on this topic going forward to address it and drill down deeper too.
All right, Chris, we have another question from the audience, if that's okay. And
yep.
You'll have to excuse the way I read these. The question appears on my screen one line at a time, so I have to move through quickly like that. It could take 6+ years to work through existing foreclosures, as there are so few buyers, and as housing prices sink. Strategic defaults get into the mix. Congress needs to address the overhang and bring new capital to that. There have been proposals for shared equity investments. What about these?
It's a very interesting proposal. I've seen a couple things dealing with those. Would love to learn more about them. On the foreclosure side, you're right that we have got to get these foreclosures through. As I mentioned, there's a ton out there, and there is a significant amount of pain that still has to be experienced. I think Congressman Garrett has very big concerns with using tax dollars, or having the taxpayers experience pain on a lot of these foreclosure sides. Unless the government's already on the hook, we don't want to take taxpayer dollars to be using to pay people's mortgages that got in over their head. So people out there who are underwater currently because they took out a home equity loan to buy a new car or go on a fancy trip somewhere, we don't feel that Congress or that the taxpayers should be paying for those people's mortgages while you have somebody right next door to them working hard, working 2 or 3 jobs to try to scrape by and make their monthly mortgage payment. So we have to be very careful in these foreclosures in terms of foreclosure mitigation efforts, that we're not using taxpayer dollars to help get those people who don't deserve it out of trouble.
Chris, this is Karen. One of the questions that we have is with regard to the FDIC, and what are your thoughts about how well is the FDIC managing their work as opposed to Freddie and Fannie, and where are the points where you think they need improvement, hearings? What are your thoughts on FDIC?
Sure. Well, the FDIC's had a very difficult job during this whole crisis. Due to the large number of financial institutions that have been failing, they have had their work cut out for them. And I think in terms of their core mission or core function of resolving failed financial institutions, by either finding new homes for them or keeping their losses minimized, and keeping the banking system and depositors insured, I think they've done a very good job with a very difficult hand that's been dealt to them. But the FDIC is very involved in a lot of these areas. They right now they're also very focused on a lot of these rule writings that are being done, specifically the one I mentioned earlier on the securitization risk retention one. The FDIC and Chairman Barry have been pretty outspoken for the need for mortgage servicing standards and how they want mortgage servicing standards included in the definition of the QRM. Congressman Garrett doesn't feel they have the authority to include that, while he agrees that there are a number of problems that need to be addressed. He differs with Chairman Barry on whether they on that question. But in terms of their core function of resolving failed banks and keeping depositors protected, I think that they've done a fairly good job.